Hello again, everyone. This is Joe Hentges with Beyond the Chart, and in this brief video, I'm going to talk about how extreme the market has been and continues to be. So stay tuned. Okay, we're going to talk in this video. I'm going to talk about briefly the CAPE ratio. So what is the CAPE ratio? The CAPE ratio is the cyclically adjusted price earnings ratio, and this is Professor Robert Shiller's ratio that he uses. This data actually comes right from Professor Robert Shiller. This is a chart of it, and it shows how, and he's talked about this many times. And by the way, I'm not going to go into a ton of detail on this. I've written about this 4 times. I've created a free PDF for you that you can get down below that goes into much more detail, talks about the perspective, talks about what's different points of view at different times here over the last year to year and a half. And so right now, what Professor Shiller has said is that there have only been 3 other times where the CAPE ratio has been higher than where it's been here over the last year. And that was, in 2007, in 2000 at the huge extremes, and then 1929. Okay, we're above these peaks, 1966 and 2001. We're above these peaks. And actually, what I'm using for overvaluation, I've decided to use the number 26, which puts it above these peaks in here so that I kind of filter out some of this. So I've really got this peak, and some of the stuff from 2006, 2007, 2008, and then what we're doing now. So let's take a look at this. So what I've done is I've looked at his data, and I have plotted on this chart. This is a chart of the Dow Industrials on a monthly basis from 1900 all the way to a current situation. So this is what, 116 years worth of market data. And here are the peaks right here, 1929, and then the period leading up to 2000. Now, what I've done is I've only highlighted the months leading up to the peak. And if I had the high reading after the peak, I ignored that because I'm only concerned about how much of advance overvaluation prior to the peak were we getting, okay? And then the same thing happened here. So let's look at, we had January to September 1929, right at the top, the CAPE ratio was 26 or higher for those 9 months, and then the market crashed, okay? And then you don't get anything in any of these rallies, the roaring 60s into the, the 50s into the 60s, no extreme overvaluation, not like this. And then it took all the way up here into the 90s. But here's the 1987 crash that everybody was so scared about, thought the world was coming to the end. Well, here's the overvaluation that occurred from January 1996 to December 1999. And all of these months were greater than 26 or greater leading up to the peak of the Dow in January 2000. And of course, the NASDAQ peaked in March of 2000 right after that. And then the next period that we've got in here is a series of higher than 26 again from December 2003 to April 2006. It was kind of like a few clusters of them that occurred. All right. That was just the start of the move to overvaluation. And then in the final segment between October 2006 to October 2007, we had 12 straight months of greater than 26 or higher. And that was right prior to the peak of October 2007. And then, of course, we all know what happened after that. So now we're getting it again. Okay, so November 2014 to May 2015 was the period of months. What is that? 7 months or so prior to the peak. Now, what's interesting is some of this data has continued to happen even now. So as we move sideways in the market here, at the top, at the high, we're still getting some of these 26 readings. We just haven't taken out the high from May 2015. Yet, at this point, that appears to be the market high. And here's the overvaluation. So what's interesting is this is a professor's approach, taking earnings, cyclically adjusting them, looking at market data. Actually, his data goes all the way back to 1884. And these are the overvaluation periods. So really, really interesting. Now, I want to tie this into technical analysis using Elliott wave. Okay, so on an Elliott wave basis, what I believe is happening is that this is the third major wave, which was the peak, a super cycle peak in 1929. We had this huge crash, super cycle 4 coming down, and we've been in this big super cycle wave 5, and it's the fifth wave from the start of the birth of our country, actually in the late 1700s. Okay, 5 major waves up. And so the wave structure that you see in this 5th wave is very clear to me. Cycle wave 1, 2, strong 3, sideways push 4, and then we get this huge move up here with overvaluation. Many people expected the market to just peak right here because this looked similar in sequence to this move right in here. And actually people were patterning it after the last part of 1929 to a certain degree too. Matter of fact, Paul Tudor Jones and his group made a ton of money because they it was rumored over $100 million in the crash of 1987 because they basically patterned after this cycle at the end right here. So he thought that was it, but we've gotten extreme overvaluation, and this wave 5 has extended, and just like we got some extension here in this wave 3. Now, the interesting thing about this is we've talked about how we're up here at the top, the overvaluation that's occurring. Wow, it happened right at a primary wave 3 within this cycle wave 5 of super cycle wave 5. Surprise, surprise, because wave 3 is typically the strongest. So huge overvaluation. The biggest overvaluation, largest overvaluation in stock market history occurred in this period. Okay, and now we got it here, like I just pointed out, and now we got it here. Now, the other thing that's interesting, why this gives me a high degree, why I have a high degree of confidence that this is cycle wave 4 that extended all the way out here. Look at the choppiness. Look how it just chopped sideways from 1966 to here. Okay, and then think about and look at the wave 4 here, right before this huge wave 5, cycle wave 5 within super cycle 3. And let's go back to the price earnings ratio. Look how low this was in July, August 1982. The CAPE ratio was 6.64, the lowest since May, June, at the bottom of super cycle wave 4, before this huge market move started in the bottom in June 1932. That was the low of the stock market, 5.57. This was the next lowest reading that we've had. We haven't even come close since then. And it's interesting how another really extreme reading, the most extreme that I've seen on all of his data, is right here at 4.78 at the end of cycle wave 4, right before cycle wave 5 kicked off at the end here. And this was right at the end of our cycle wave 4. So the pattern of his extremes, extreme lows and extreme highs, fit in very nicely with what I'm seeing in the Elliott wave count that I'm seeing in the market. But even if, let's say, some people say, I don't buy into this wave structure, I don't really like it, all you got to do is look at, from an earnings perspective, if you say, well, I kind of understand, I believe in earnings and, all of that. I'm trying to blend the two and show you the two perspectives, how the two perspectives are matching and sending the same message. They're screaming the message loud and clear, okay? And what Professor Schiller will tell you is that the average price earnings ratio is 15 over like the last century or so. Okay, and we continue to have this overvaluation. So, we're in, my take is in for a major adjustment. I think it's going to be very significant, but also, you can do it you can get there based off of this, or you can get there, you know, based off the Elliott wave theory and where, you know, it's going to pull back and the fact that we've had our 5 waves and we're at the extreme. Either way, the message is caution and get prepared.